How and why managers use budgets? It's really important to understand that. How are budgets used? Well, they develop strategy. They help in the planning process. They act, they execute, and you get a performance report knowing whether your control measures are working, and then you receive feedback to identify corrective actions so that you can redevelop your strategy. How are they developed? The budgets begin with company's overall mission or purpose statement. They develop long strategic goals, setting long-term goals that extend 5 to 10 years into the future is strategic planning. When you design plan to attain goals, you have shorter-term budgets. A rolling budget continuously is updated so that the next 12 months of operations are always budgeted. So you're going to have strategic planning where you set long-term goals that extend 5 to 10 years into the future. And you're going to have shorter term budgets to meet those objectives, and then you're also going to have a rolling budget which continuously updates so that the next 12 months of operations are always budgeted. Who is involved in the budgeting process? Well, the budgeting process is participative. It involves participation of many levels of management. Lower level managers closer to the action, they're more likely to be motivated by a budget they helped create. Participative budget could be more complex and time consuming, and it may intentionally build in some slack. And there's also budget committees that are formed within organizations to involve them in the budget process as well. What is the starting point for developing the budgets? Use the prior year budget or actual results as the starting point. So you always want to look at what happened in the past and then make projections for the future. You want to modify to reflect new product, customers, or geographical areas, changes in the marketplace, changes in labor or materials, general inflation, and new strategies. There's also zero-based budgeting where managers begin with a zero budget versus starting off with a previous, and they must justify every dollar. So with zero budgeting, managers begin with a zero budget and they justify every dollar. What are the benefits of budgeting? Well, planning. Budget forces managers to plan. Communication, they're forced to communicate because it's participative. You budget, your budgets promote coordination and communication. And benchmarking. Budgets provide a benchmark that motivates employees and helps managers evaluate performance. Now let's look at the master budget. We start beginning to fulfill the objectives for this week with the master budget. In the master budget, we look at comprehensive planning, and comprehensive planning has to document for the entire organization. It consists of supporting budgets, such as an operating budget and a financial budget. With an operating budget, it's needed to run daily operations of the company. It's culminated in a budgeted income statement. Okay, so remember that operating budgets, the word operating always refers to revenues, expenses, which are the daily operations of the company, and revenues and expenses are the elements inside the income statement. So remember, operating budgets are needed to run daily operations of the company, and they culminate in budgeted income statement. Financial budgets include capital expenditure budget and cash budgets. They culminate in budgeted balance sheets. Now, the master budget for a manufacturing company consists of, you have a sales budget, then you have a production budget, and then right under the production budget, you have 3 budgets that are right under, and that is a direct materials budget, a direct labor budget, and a manufacturing overhead budget. Now those terms should be very familiar because those are very important, especially when you know that the cost of flows, the flow of costs that are associated with with assembling a particular product, involves those 3 things: direct materials, direct labor, and manufacturing overhead, just like as we saw with the guitar. So looking at the master budget from a hierarchical perspective, you have a sales budget on the top, Right below it, you have a production budget. And then right under that, you have three budgets that are lateral. And you have a direct materials budget, direct labor budget, manufacturing overhead budget. Below those three, you have operating expenses budget, a budgeted income statement, and under those, you have a capital expenditures budget. Right under the budgeted income statement, you have three different types of budgets that are lateral, to each other. And that is a capital expenditures budget, a cash budget, and a budgeted balance sheet. Now, how would you prepare the operating budgets? Well, the starting place for budgeting, you're going to look at the number of unit sales times the sales price per unit gives you total sales revenue, something that we've seen before. So let's give an example. If Tux and Tortilla expects to sell 30,000 cases at a price of $20 per case, 30,000 times the $20 per case is 600,000 total. So that would be the total sales revenue. If you sell 30,000 cases at $20 per case, you get $600,000. And then of course your sales budget is going to have, you're going to have, if you look at an Excel spreadsheet, you're going to have January, February, March. So you're going to have a column for January, a column for February, a column for March. And in each row, the first row could be the unit sales of the cases. Multiply them by the sales price per case, like we did, 30,000 cases at $20 per case, 600,000. But maybe in February is a little different. Maybe February is 20,000 cases at $20 per case. So that would be $400,000. So that's how you would start the operating budget with the sales budget. How about the production budget? Decide how many units the company needs to produce. And there is what is called safety stock, which is inventory kept on hand in case demand is higher than predicted. So how does the production budget take place? Well, the units needed for the sales plus the desired ending inventory is going to equal the total units needed. Now, once you have the total units needed, you're going to subtract the units in the beginning inventory, and that's going to be equal to the units to produce. Now, in the production budget, step one of the production budget is going to be to figure out the total units that the company needs. So Tux and Tortilla wants ending inventory equal to 10% of next month's expected sales, which are going to be 20,000 cases. So you get 30,000, which were the initial amount of cases, plus 10% of the 20,000. That's going to give you 32,000 total cases needed. Now, in step two, you're going to calculate the amount of inventory expected to be on hand at the beginning of the next month. So if they expect to have 10% of January sales on hand on December 31st, that's going to be 10% of the initial 30,000 cases that they had. So 10% of 30,000, 3,000 cases in beginning inventory. And then of course, you're going to have the Excel spreadsheet. The columns are going to be January, February, March. And the rows on the left-hand side are going to be unit sales, the cases, desired ending inventory. And at that point, that's where you're going to take 10% of those to figure out what you need the following month. Total needed minus your beginning inventory are going to be the number of units to produce. And then you have a direct materials budget, which is the quantity of direct materials needed for production plus the desired direct materials ending inventory is going to be equal to the total quantity of direct materials needed minus the direct materials beginning inventory. It's going to be equal to the quantity of direct materials to purchase. The direct labor budget, you're going to need the units to be produced times the direct labor hours per unit is going to be equal to the direct labor hours required times the direct labor cost per hour is going to equal the total direct labor cost. And then you're going to have a budgeted income statement, just like a regular income statement, except that it uses budgeted data. So you're going to have sales revenue minus the cost of goods sold, what it costs you to acquire the goods. That's going to be your gross profit. Once you have your gross profit, you're going to subtract operating expenses, and you're going to get the operating income. And then you're going to subtract any interest expense and any income tax expense. It's going to give you your net income. You're going to see that in the budgeted income statement, there's going to be a section where you compute the cost of goods sold, which is also the number of unit sales times the manufacturing cost per unit. That's going to give you the cost of goods sold. Now, how about the financial budgets? The financial budgets consist of capital expenditures budget, cash collections budget, cash payments budget, combined cash budget, and a budgeted balance sheet. The capital expenditures budget includes, for example, assets, computers and printers, delivery vans, production equipment, and total new capital investments. The cash collection budget consists on timing. When does the company expect to collect cash from sales? So January, February, March, first quarter, second quarter. What are the collection on credit sales? If you're going to have 85% of credit sales made 1 month ago, 14% of credit sales were made 2 months ago, that's included in the cash collections budget. A cash payments budget focuses on timing as well. When will the company pay for its expenses? Direct materials purchases, direct labor costs, manufacturing overhead costs, operating expenses, capital expenditures, income taxes. Now, a combined cash budget merges budgeted cash collections and cash payments. Budgeted cash collections are added to beginning cash balance to determine total cash available. Budgeted cash payments are then subtracted to determine ending cash before financing. And a company can determine if it needs to borrow money or if it has excess funds for investing or paying off debt. In sensitivity analysis, remember the what-if technique that we also saw in the last video lecture. The what-if technique that asks what a result will be if a predicted amount is not achieved or if an underlying assumption changes. Well, you would look at the original budgets, what if, modified assumptions, and then you revise your budgets. Flexible budgets are prepared for different volumes of activity. They are often used to evaluate performance. Now, how would you prepare budgets for a merchandiser? Well, service companies have no merchandise inventory. Operating budgets include only sales budget, operating expenses budget, and budgeted income statement. So a master budget for a service company, you'll have a sales budget. Right underneath it, you'll have an operating expenses budget, and you'll have a budgeted income statement. And those three will be your operating budgets: sales budget, operating expense budget, and budgeted income statement. Underneath the budgeted income statement, you'll have your capital expenditures budgets with the cash budgets and the budgeted balance sheet. Those will be your financial budgets. Now, merchandising companies, they focus on direct materials, direct labor, and manufacturing overhead budgets. So you're going to prepare a cost of goods sold, inventory, and a purchases budget. The same general format as manufacturer's product budget, except uses cost rather than the units. The master budget for a merchandising company has a sales budget, cost of goods sold, inventory and purchases budget, an operating expenses budget, and a budgeted income statement. And below that, you still have your three financial budgets, which is the capital expenditures budget, the cash budgets, and the budgeted balance sheet. All right, so this concludes the high-level overview of our budget section that fulfills the week 5 objectives. And then we're gonna focus then on some of the outcomes of performance evaluation, by understanding decentralization and describing different types of responsibility centers. So during the decentralization, operations are split into different operating segments. Management delegates decision-making responsibilities, and that may be based on the geographic area, the product line, the distribution channel, the customer base, the business function, and so forth. There are advantages of decentralization. It frees top management's time, it encourages use of expert knowledge, it improves customer relations, it provides training, it improves motivation and retention. Some disadvantages are potential duplication of costs, potential problems achieving goals in general. In performance evaluation, it provides the management with feedback it needs to maintain control over the entire organization. To be effective, performance evaluation systems should clearly communicate expectations, provide benchmarks that promote goal congruence, and motivate segment managers. When we look at responsibility accounting, we have a responsibility center and a responsibility accounting system. The responsibility center is part of an organization whose manager is accountable for planning and controlling certain activities. And as an example, lower level managers are often responsible for budgeting and controlling costs of a single value chain function. And in responsibility accounting, it's a system for evaluating the performance of each responsibility center and its manager. The performance reports compare budgets with actual results for each center. The responsibility centers consist of a cost center, a revenue center, a profit center, and an investment center. In a cost center, such as a manufacturing plant, managers are responsible for controlling costs. In a revenue center, such as the Midwest sales region, managers are responsible for generating sales revenue. In a profit center, such as a line of products, managers are responsible for generating income and controlling costs. At an investment center, such as the Frito-Lay division, managers are responsible for income and investment capital. So remember, cost center, revenue center, profit center, and investment center. So in a cost center, remember, managers are responsible for controlling the cost. In a revenue center, it's a particular region for certain products. It could be for Frito-Lay products, responsible for generating sales revenue. Profit center, the line of products, and managers are responsible for generating income and controlling costs. And the investment center, imagine if Frito-Lay wanted to build a new Frito-Lay plant. And of course, you have an organizational chart with the chief executive officer. And then you have the different divisions. You can have the vice president of the North region, the vice president of North America. You can have the vice president of the Middle East, Asia, North Africa. You can have those vice presidents under the chief executive officer. And then you also have managers below the vice presidents, where you have the manager of Pepsi, the manager of Gatorade, the manager of Tropicana, the manager of Mountain Dew, and the manager of Aquafina. And then lastly, we're gonna go over explaining how and why standard costs are developed. So a standard cost is a budget for a single unit of a product. You will develop a standard cost for each type of product, and service companies use standard costs too. They become benchmarks for evaluating the actual costs. So if we look at Colgate, Palmolive, they're going to develop a standard cost for each type of toothpaste, soap, and laundry detergent that it produces. Service companies such as hospitals develop standard costs for routine procedures. And some types of standards are ideal standards. They're based on perfect or ideal conditions. Perfection standards do not allow for any poor quality raw materials, waste, machine breakdown, or other inefficiencies. Perfection standards can include lean production systems. Practical or attainable standards are based on currently attainable conditions. They allow for normal waste and inefficiency. Computing standard costs, well, manufacturers prepare standards for the direct materials, the direct labor, the manufacturing overhead, which consists of variable and fixed costs. So if we looked at a standard cost of direct materials, we look at the standard quantity of direct materials times the standard price of direct materials. That will give you the standard cost of direct materials. So as an example, if Tuxpan tortilla requires 5 pounds of flour at $1.50 per pound, that's 5 pounds at $1.50 per pound, you get $7.50 per case. Now we look at another one. If Tuxpan tortilla requires 5 cents of direct labor hours per case at $22 per hour, you look at the 5 cents hours times $22 per hour, you have $1.10 per case, and so forth. Now, total estimated variable manufacturing overhead divided by total estimate amount of the allocation base equals your variable manufacturing overhead rate. And then you're going to see that you're going to have several formulas for your standard cost of manufacturing overhead. Now we're going to go ahead and ensure that you are ready for the week 5 assignments that you're going to successfully complete. So if we look at your week 5, your first discussion question is going to be explain the usefulness of the master budget. Well, excellent. You have the foundation for that. The second discussion question, elaborate and provide examples describing how and why managers use budgets and prepare operating, financial, and merchandiser budgets. Well, excellent. You have the foundation for that as well. And then you're going to do some critical thinking and explain why evaluating direct materials are important. And they're going to have also variances. And your week 5 essay assignment is going to be about identifying and understanding budgets. Identify the order in which a manufacturer would prepare the following budgets, and also know whether each budget is an operating budget or a financial budget. So, keep in mind you got 2 categories: operating budget, financial budget. So you have a budgeted income statement, a production budget, a combined cash budget, a budgeted balance sheet, a direct materials budget, a cash payments budget, and a sales budget. Then you're going to look at sales budget for a retail organization. You're going to use Frederick's Bookstore as an example, which is an on-campus bookstore for students and faculty. And the bookstore shows the following sales projections in units by quarter for the upcoming year. And they're going to give you 4 quarters, number of books, school supplies, apparel, and miscellaneous for the 4 quarters. And then they're going to give you the average price for each item in each of the departments as follows. So you're going to have the price, for example, for books, supplies, apparel, and miscellaneous. You're going to organize the data provided in Excel. You're going to use rows for quarters and columns for items. And you're going to prepare the sales budget for the upcoming year by quarter for Frederick's Bookstore. And sales are going to be categorized by the 4 product groupings: books, school supplies, apparel, and miscellaneous. Then you're going to do a 1,200 word analysis of the concepts from this week's readings as you respond to the following. Conduct an analysis of a sales budget for Frederick's Bookstore and discuss the other types of budgets that you can prepare for Frederick's, whether or not you have the data. So here's again where you're going to think outside the box and beyond the box. You have a good foundation regarding the budgets, as well as performance management and all the decentralization aspects of an organization. So good luck in week 5, and we'll remain available in the online course to see if you have any questions on anything. Thank you and good luck.